study, you will have the data, the funding to do all that. It is also, you also you also be able to manage bring it into a manageable scope, and it has to be practical. We also talked about originality yesterday, that it addresses an identifiable gap in literature. When you want to carry out a research, first, what is it that you want to achieve? What is the research gap? And you can only get your research gap through literature, past literatures. So the first step, even when you want to identify a gap in literature, you have to do what is called literature mapping. You have to check recent journals. In research, 5 years, 7 to 5 years is a good time frame to review literatures within that period. You look for those journals, related topics to the one you've chosen. You have to go through it, have your mapped literatures. From there, you'll be able to identify the gap in literature. You're able to know, see the year in which that particular literature was, or that particular study was carried out. From there, again, you notice that most of those studies were done outside your domain. For instance, if you're carrying out a research in Nigeria and you discover that majority of the literature you see were carried out in Asian, European countries or other African countries, you've already identified a gap. Or you see that there are no empirical literatures on that topic, they are very scanty and few. Is also a gap that you've identified. You can as well identify a real life, a real world research gap before you be able to know that, will I be able to carry out this research to a conclusion, or at the end of the day you get to somewhere, maybe you've written, find a way to write your background, find a way to set your objective. By the time you get to problem, you realize that there are no problems. You don't even have any problem because you've not really carried out a literature review before then. Then when you even manipulate and leave all those places, when you get your empiricals, you find out that there are no literatures. At that time now, you want to either back out, start a new topic. So it's very important, before you start up any topic, you choose any topic, carry out a preliminary literature review of past literature so that you'll be able to identify a gap, the reason you want to investigate this thing. Is it that they were having conflicting results? When you review those literatures, you find out that the same thing, the same dependent variable, the same independent variable, one person is getting a negative or an insignificant result, another person is getting a positive significant result. You want to investigate the reason for that conflict. So when you want to carry out to have a research topic, make sure that you've already carried out your literature matching, get to identify gaps. We talk also about significance. Research should matter. It should be of benefit both in academics and practically. People who are in that sector, the managers, they should be able to make decisions with the outcome of that research. Then in academics, we should add to the knowledge, the current the knowledge in that particular field. We also talked about empirical studies. Empirical studies are studies that must contain a hypothesis. There must be a hypothesis that you are testing. When how do you, okay, let me go back to literature review. How do you get those literatures? The databases where you are to get those literatures. You use Google, and I don't know how you just type into the Google and just ask. But I don't know if you know about using PDF, the dependent and independent variable you want to investigate them empiricals. When you use these PDF and empiricals. It will bring out empirical literatures that have hypotheses, that have method of analysis, that you dependent and independent variable. If you impute it just like that, just put in the topic, you are going to get a lot of things that are not related to empirical studies. So when you use these techniques to search for literature online, you are able to get enough literature on that. That from there, you even know if that topic you have enough empirical studies on it to carry out that section. So before you take up, make sure that you have that literature, you had enough literature, you have identified your gap, and before then you have the availability of data. If you don't have data, especially for in accounting and finance research using secondary data, we usually rely on financial statements. You'll be sure that you will be able to access those financial statements of selected of the company or the sector you are choosing to carry out your research on. If you don't have that, I think you rethink on the topic. We also talked about key research areas in accounting and finance, the corporate finance. We have topics like capital structure, dividend policy, corporate governance, investment decision. All these examines how these decisions affect firm value, the risks, and the performance. In auditing, we have areas like audit quality, earnings management, auditors independence, and audit regulations and outcomes. In taxation, we have topics that is that subject area. We have the subject in taxation, we have tax compliance, we have tax avoidance. In financial management, in financial accounting and reporting, we have accounting standards, and we have earnings management, we have disclosure practices. That is for accounting. So like yesterday when we started, we said you should know your subject area. So these are the likely topics that we have in accounting and finance. It's just narrowed to Anna University courses. That's why we just brought out these ones. So the framework for research topics, we also talked about it yesterday. We talked about SMART and FINA. We said that SMART is specific. That means you should be focused and clear on the topic. The topic should be focused. Then it must be measurable. You should be able to the phenomena should be able to you should be able to observe it. It's not something that you cannot measure. Then it has to be achievable within the year of your study. You have to achieve that research. You don't start a research that your program is a 3 years program and you are carrying out a long research that will take you 5 years. It's not an achievable research. Then it has to be relevant. It has to align with your field. You will not be in accounting or in finance and your research topic is reading management. So it has to be relevant to your field and it has to be time bound, just like we said. You must finish it within the time of your study. Then we also talk about the final, which is visible, interesting. You have to have passion for the topic you want to write on. You have to put in yourself into it. If you don't have yourself, if you know where you have passion for, you will not be able to carry it out. So research is all about your passion. Your passion drives how far and how deep you can go into your research. If you don't have interest in your research, you will not. It will be difficult when you come for defense. If they're even asking you questions, you won't be able to answer it because you are not in it. When you write a research, you have to be in it. You have to be in that your work. You have to have passion. It's something that you want to find out. You are eager to. You have to be in it. If you are not in it, it's not interesting. You'll not be able to carry out it. It has to be a novel. It has to be ethical. You are not violating from what you're going into. You are not violating any ethical rules. It has to also be relevant. Somebody you have to be relevant in academics, you have to be relevant in practice, you have to just be relevant. You don't just do it because let me just have the certificate, let me just finish and dump it there, and it will just end up in the shelf. It has to be something that even when you finish, you will be able, when you are talking somewhere, you'll be able to say, "Okay, I carried out this research, I found out this." When you're discussing, you'll be able to say, "This is what I did, this is what I found out." You'll be an authority in that field. So we also define the variables. We also define dependent variable, because in a research topic, you must have a dependent variable, you must have an independent variable, you must have a domain for that research topic. So we said the dependent variable is the primary outcome of interest in the study. What it means is that that is the effect. That is what you are seeking to explain. That is dependent variable. That is the effect. That is the problem. That is what you want to solve. That's what you want to find out. What is the problem? That is, I don't even know. It is interest. You want to know what will finally happen to this particular variable. Then independent variable, we say, is the factor that can be manipulated. You use it, is a cause, You use it to observe the effect on the dependent variable. You can also refer to it as a predictor or explanatory variable. Okay, the dependent variable in your topic is a lump, but when you are writing, you have to break it down into proxies. Each of those proxies will be used to test against that dependent variable to find out the effect, to find out how does the change in the independent variable, how does it affect the dependent variable. That's the one you break down to proxies. Those are the ones that will form your objectives. I hope you know that your objective, your question, your hypothesis, they are all the same. Just that one is in statement form, the other one is in question form, then the other one is in null or alternate form. They are the same thing. So it's the independent variable proxies that you will use to formulate your question, you use it to formulate your objective, you use it to formulate your hypothesis. We also talked about control variable. We say that it's an additional factor that is included in the model. You don't conceptualize your control variable. They are the variables that, okay, if I'm talking about corporate governance, and I've talked about how it affects earnings management, and I use board gender diversity, I use audit committee independence to check how it affects earnings management. Now, there are other factors, earnings management, there are other factors that are not considered in the main topic. It's not part of the objective, you did not conceptualize it in chapter 2, but it will be in your model. The reason for this is that it's not just those proxies that can affect the dependent variable. A size of a firm can also affect the level of earnings management in an organization, the profitability, the leverage of that firm. So those are the variables that are the additional factors that are included in the model that ensure that you observe the relationship between the IV and this thing, that is not distorted by the omission of that factor. If you don't put it, you might say, okay, what if the size of a firm now affects, regardless of the gender diversity, what if the size would have affected? So you provide for that control, so that you also consider such, but you're not going to conceptualize it. What I mean by conceptualize, it's not going to be as a concept in your work, but it will be in the model, it will be in your framework as well. So we also talked about the dummy variable. We say is called an indicator variable. It takes a value of 0 or 1 For instance, male and female. If you say both gender diversity, is either there is male or female. So is either male is one, female is zero. That's the categorical. That's to represent the categorical variable in a regression model is a dummy. Is something that is categorical. Is either is one, is either is a male or is a female. Is either so it doesn't have any other a different interpretation. Is either zero or one. We also talked about the moderating variable, which is the interaction time. We say that it affects the strength or direction of the relationship between the IV and the DV. That is a moderating variable. It either enhances it or distorts it. So it reveals conditional relationship that would otherwise be overlooked. There are relationships within the independent and dependent variable that ordinarily would have been overlooked. But when you introduce a moderating variable, you find out that it will either enhance that relationship or distort that relationship. Most of our topics in Anna University, we use a moderating variable. So to make a difference, that can even be that's a gap also. You can introduce a moderating variable to give your work a kind of make it different from if they tell you that this thing is overflooded, you can introduce a moderating variable to still be able to carry out that research. We also talked about the mediating variable. We say it explains the mechanism through which the IV influences the DV. I think that was all we did yesterday before we now went into the methodology Dr. Akpadaka will handle. We just wanted to recap so that we don't forget how we got to the regression aspect of these classes. Thank you. I don't know, Dr. Akpadaka, are you here? Hello, sir. Any question, any contribution?
Yeah, good evening, Dr. Onyechi. This is Francis. I just want to know if there is a difference between mediating variable and moderating variable.
Yes, sir.
Okay.
They're different.
Okay, I have a similar question so that we just take it together. Good evening, Dr. Precious. Good evening, Dr. Simon.
Yeah, Dr. Wabla, good evening. Thank you.
Okay, in line with Dr. Francis' question, so that it will be taken together. Yesterday, we tried explaining this moderating and mediating variables. So, and it didn't sync kind of well. So I was like, can we have a real phenomenon and use these three types of variable, that's moderating, mediating, and control variables, to kind of expatiate between these three.
Okay. Can I
Yes.
can I come? Dr. Precious.
Go ahead, sir.
Okay. We did some drama yesterday, but I won't go into that drama. It took some of our time. Dr. Wabla, and I didn't get the name of the person that asked the other question, please. I think issue of moderation, mediation. These two are they are two distinct approach to modeling. And I want to toe the part of Dr. Wabla, and that's what I have for tonight. It's part of the things I have tonight, that we have a practical demonstration of what mediation looks like, of what moderation looks like. But to just answer in a nutshell, while we proceed into this other half of the session, when you are mediating, you are just a go-between. You are an intermediary. It's like Mr. President has a message to deliver. He's not going to call you. Probably the chief of staff or somebody is going to send the message to you. So that chief of staff or whatever he is a mediator. But when it comes to moderation, which is what we also call interaction, moderation, there is a relationship between the independent variable and the dependent variable. But a third variable comes in to join force with the independent variable to have impact on the dependent variable. That is when we say a moderation has taken place. Mediation has to go through the third variable in the relationship. If ROA, that's a return on assets, we are hypothesizing that it's having effect on firm value. That is the direct effect. Under what's it called? If we are moderating, you can hypothesize that dividends moderates the relationship between ROA and firm value. In that case, what we are saying is that a firm that is paying dividends, a firm that is profitable, and at the same time paying dividends, will have the value enhanced. That means the dividend payments come to strengthen the value of the firm. But there is a direct relationship of profitability on a firm value. But if a firm that is profitable and at the same time is paying dividends, the value of the firm will be enhanced. So dividends is coming in to be the enhancer. Is joining forces with profitability, knowing fully well that a firm that is profitable is the one that has the chance of paying dividends. And if it can be profitable and not paying dividends, that's possible. But now, if you pay dividends, dividend now becomes the icing on the cake. It joins force with ROA to impact positively on a firm value. So that is moderation. Mediation is, we are saying that we can hypothesize the same dividends that ROA has a direct impact on a firm value, but can it also pass through dividends to have an impact? There is a direct part, but can it pass through the dividends to have an impact? So if it's able to pass through dividend to have an impact, when we statistically test it, we can say that there is a mediating part. The mediating part is actually an indirect part because you are going through another independent variable to have effect on the dependent variable. I don't know whether that makes let me call it a theoretical explanation. Maybe it makes it a little clearer. Maybe when we put it into practical session demonstration, we can get a clearer picture. Are we okay with that?
Yes, sir.
Dr. Precious, are you done?
Yes, sir. You can go ahead with it.
Okay. Dr. Wabla, I didn't hear your voice, and the other man.
Yes, sir. I like the way you explained the mediating. So, but if you're choosing mediating variables now, will you add it and begin to do what do you call it? Not empirical, conceptual. Like it adds to your variables.
We are going to I'm not sure I got you well, but we are going to do practical sessions that will do moderation, and we'll do mediation.
Okay. Okay.
If I
Yes.
understand what Wabla is asking, he's saying, when you are doing mediating, do you conceptualize it? Does it come under your concepts and your? Wabla,
no, it's important. It's important. Yeah.
Yes.
It's important to do that. It's important to do that. In fact, you need to concept very, I mean, both mediation and moderation. You must conceptualize. You conceptualize, you want to justify it's an argument you are making. Argument in the sense that you are proposing that there is a moderating effect. So you must bring in that connection between the among the what's it called, independent variable, moderating variable, and the dependent variable. Those is more like you have to conceptualize it and bring forth the argument to justify the basis of why you are bringing them in. And is it you have to use the theory to back it up, because you don't just
moderate. Mediating also.
Yes, the same thing is applicable to the mediating. Okay. You don't just mediate, you don't just moderate. You must bring in the theory that that you can rely on. You understand? Because my thesis was on I use what's it called, profitability to moderate the relationship between capital structure and dividend policy. So I needed to strongly justify the basis of my moderation, most especially when I was eventually published my my work in the Scopus Index journal. You understand? There was, in fact, the reviewer are more interested in the justification to be able to that I can make strong justification for that. You understand? So for both, you need the theoretical argument and you need to draw that connecting dot to make a case for your your moderating or mediating effect. I think that's that for now.
Okay, Dr. Simon. So control variable is different because you don't have to conceptualize it.
No, you don't have to conceptualize or control variable. They are confounding variable. You are just bringing them in. These are other factors that are impacting that other work are found to have impacted. You cite sources that have also used them. Since you are not conceptualizing, but you need to cite sources to back them up. You understand?
Okay.
Thank you, sir.
Hello, Dr. Simon. Hello, Dr. Simon. Good evening.
Yes, sir.
Please, I'm still on these variables and basically on a dummy variable. I remember yesterday yes.
Okay.
Dummy variable, yes. I remember yesterday you tried to explain it by using a binary number 0 and 1. And you say we can use 0 to represent 0 or 1 to represent companies, maybe in the case of trying to explain different companies. And you also said, yeah, we can use yes or no in form of dummy variables. And I want to ask, can we still say that dummy variable can be likened to dichotomous variable?
Dummy variable are dichotomous variable because it's a value of 0 and 1.
Okay.
Yes.
Thank you very much.
Welcome. Okay. That said, we'll move into our section for today. Dr. Precious, thank you for that recap of yesterday's section. I think network robbed you off of the better time of the time yesterday. But it's good we have you around today. Thank you very much.
You're welcome.
Okay, so today we are looking at like it's a continuation. So we are looking at choosing the right statistical tool for your analysis in finance and accounting research. That is choosing the right statistical tools. Precisely, we are looking at your model formulation. Selecting the appropriate statistical method is crucial for ensuring validity and reliability of your empirical research in finance and account. The choice of a statistical tool depends on the nature of the research question, the type of data, and the underlying assumption of the model used. Often than not, let me draw it from the beginning. Let me draw it from the beginning that your dependent variable is number one determinant of the statistical method you are going to use. I'll take that again. It's simple. Your dependent variable, your DV, is number one determinant of the statistical method you're going to use for your study. The other thing is, when I say, okay, let me go deep a little into that. Why am I saying your dependent variable? If your dependent variable is binary, you cannot use OLS regression. If your dependent variable is categorical, OLS regression is not the most appropriate. If you want to make prediction, I think Sadia, is she in the house?
I am in the house.
Yes, sorry, your DV yesterday, can you give us a recap of it?
Okay.
Your dependent variable.
Yes, my dependent variable. Initially, it was electronic fraud prevention. But when in the process of collecting the data, we realized we have to use a dummy variable, because most of these organizations, since it is an issue of fraud, they don't want to disclose it. So most of them just stated that there's fraud or none. Or some of them, if there's no fraud, they just keep quiet. They don't say anything. But when there's fraud, they report, yes, there's fraud. But it's not, some of them went extra mile to explain the number of cases, and some of them stated the amount lost. But it's not all of them. A majority of them did not. So the only option I had is to know whether there is fraud or not. That is how I use binary. Companies that reported cases of fraud, I use 1. Companies that did not report, I use 0. That is how I came up with my binary. So because of that, I had to use logistic regression because of that dependent variable.
Fine, because of the dependent variable. Whether if they disclose 1, if they don't disclose 0.
Okay, sorry, I have a question, Dr. Sadia. Okay, you used financial statements.
Yes.
Because yesterday I heard you saying you interviewed people. So I wanted to find out, is it from the interview or financial statements?
Okay, let me clear this. When I actually use financial reports, secondary data, that issue of interview was for something different. I was writing a paper, so I was using primary data. That was when I mentioned that. For this, when I went for defense, Professor Mlanga said it is not possible, that he has a site that I think if, so I don't know if you can remember, some of you, when I did my, what do you call it, proposal defense? No, terminal defense. Professor Mlanga raised the issue. He gave me a site that researchers use to get that, to get those information. So I went to the site myself and found out that they stated total number of reported cases and total amount lost, but they didn't say this amount is for this bank, this number is for that bank. You understand? They only reported for the period. So I went back to him. He went to check himself. He saw it is the same thing. Dr. Dank checked, as in everybody checked and saw that yes, I didn't have option. That was how they accepted my this thing. I had to use binary data. Are you, Doctor?
Okay.
Doctor, are you clear?
Yes, yes.
Okay.
Okay. So that I just brought that in to support the argument that your dependent variable is the number one determinant of the choice of your statistical tool. You understand? The choice of your statistical tool depends on the nature of your research question, the type of data available, and the underlying assumptions of the model used. If when you talk of underlying assumption, OLS often are not assumed normality is built on a normal distribution assumption that your data is your dependent variable is normally distributed. You understand? And it also, apart from the normality, there's the issue of homoscedasticity. Those are some of the assumptions of the what's it called, OLS. But it's not every time. It's not all the time that all our researches meet this normality assumption. Even though there are some school of thought that have argued that you can use OLS if you have a sufficient number of quantity. Number of observation. If you're having like 200, 300, 500 observation, irrespective of normality assumption of the OLS, they argue that there is what is called asymptotic normality that you can rely on and still use the OLS. But but one thing that is most important for you is when you are using OLS, is built on the assumption of, what's it called, continuous variable. OLS uses continuous variable. If your dependent variable is not a continuous variable, you can't use OLS. Sadia cannot use OLS for our work because it's binary. It's either take 0 or 1. You understand? And OLS work as a pool data. When we say pool data, we are saying irrespective of the class, if, for instance, I want to take a survey of people in this online meeting, I'm not interested whether you are a PhD student, I'm not interested whether you are MSc student, or I'm not interested whether you are from Anna University. You might be from any, but I'm interested in, I want to take sample, I want to take survey from, let me call it, graduate students. So I'm doing, what's it called, a pool, I'm pulling from the population, my sample, regardless of the class. You understand? So if you are not interested in the class, pool OLS regression becomes applicable. But if you are studying, yes, you are studying firm performance, and you are relying firm performance, determinants of firm performance on the Nigerian Stock Exchange, and you are relying solely on OLS regression, there is a problem. Why? Because you are not taking into consideration perhaps their industry. You are not taking into consideration firms operating in the banking sector or in the financial sector are different. They are differently regulated from firms operating in the non-financial sector. Are you getting me? So OLS will not take into consideration those classes. But there is a way, even if you still want to use OLS, there is a way you can bring in such attributes. That's when you start bringing in the issue of a dummy variable. Are you getting me? If you now code banking sector 1, non-banking sector 0, you have at least in a way brought in their, what's it called, their sectorial differences to mitigate against issue of non-classification. But again, if you use OLS, perhaps if you consider using panel data. Panel data, and that's why you say, I mean, from what is on the screen, OLS assume homoscedasticity. It takes them like all the firms in the group, they are operating under the same condition. They have, let me say, equal. The condition in which they are operating is similar. You understand? But you and I know that even companies have their own unique. Even banks, Echo Banks, what's it called? Culture might be different from a Zenith Bank culture, work culture, and it might be different from Stanbic Bank culture. And this is where what's it called? Panel data regression take superiority over OLS regression. The same regression, but is taking into consideration their attributes. That's when you use the fixed effect and the random effect. When you do your Osman test, you want to know which one is is preferred option. Should you use Osman? Should you use a random effect or fixed effect panel data regression? If you are using, once the Osman test tells you you have to use fixed effect, what that test is telling you is that there is what's it called? Homoscedasticity is violated. If homoscedasticity is not violated, you use what's it called? Random effect. Random effect is as good as, is equivalent to the normal ordinary least square. That's the OLS regression. The only difference is now in panel form. But the issue of OLS assume homoscedasticity, but panel data does not assume that homoscedasticity like that. So when to use panel data has both cross-sectional and time series dimension. Unlike OLS does not have that cross-sectional, because it just assumes everybody they are equal. The same, irrespective of your whether you're a analyst student or a PhD or MSc, everybody here is a student. That's what OLS is assuming. But a panel data want to take into consideration, okay, perhaps let's have a master separate, let's have a PhD separate, before we administer our test. You understand? So it takes into consideration that uniqueness, that attribute that distinguishes, like the class difference. Let me put it that way: the class difference in between them. So that is, I'm just giving you the difference between the OLS and panel data regression. And for panel data, we have the fixed effect. Fixed effect more like concentrate on that firm unique attributes. Random effect is similar to OLS, like I said. It's just that it's in panel form. Sorry, I'm using two systems. I'm trying to, because my audio on my laptop is no good. I don't know what's happening there today. So I'm alternating between the two. So I've talked about OLS regression. I've talked about the panel data regression, and either using a fixed or random effect, which will be based, normally is based on the choice between a fixed or random effect is based on you conducting the Osman test, and that will give you the direction whether to use a fixed effect or random effect. The next regression, that you can think of using for your work is often not so popular, but if you know it, I think it's something that is worth considering. We have the two-bit regression. When do we use the two-bit regression? You see, when your data is skewed, it might be skewed to the right or skewed to the left. What do I mean? Take, for instance, when we talk about dividend payments or detection of fraud, for instance, dividend payment or the detection of fraud, there are chances that a lot of companies might not be paying dividends. That's one. And when you pay dividends, if you pay or you don't pay, the least value you can get is zero. You can't get negative dividends. Unlike maybe when you are talking about profitability, profitability can be both in positive and negative. It has no boundary to the left, no boundary to the right. But dividend has a boundary on the left. When I say on the left, dividends cannot go below zero. So this is what is called censored data. Your data is already, by the nature of the data, you know that your dividends cannot be negative. The worst your dividend can be zero. So if you want to, if you are looking at determinants of dividend policy, and you discover that there are a lot of companies are not paying dividends, rather than using OLS or using a panel regression, most appropriate for you will be to use a two-bit regression. And if you are looking at detection of fraud, no, that's even that's binary. We can't use a two-bit for that. Sadia's work is a binary. So, but censored data, data, that's when your what's it called? Two-bit regression becomes applicable. To explain censored data further, let me just quickly look at we know JAM score. University, what's it called? The JAM authority will come and tell you that the cutoff point for admission in a year is around maybe 120, 150 or so. Am I right? So if you know that for you to gain admission into school, all other things being equal, you need a minimum of maybe 120 in your JAM score. And if you are doing a determinant of what's it called, getting admission into university. Already your data is censored. That means before anybody, the minimum score you must get is 120 before you now talk of maybe the departments and what's it called, internal examination and the rest of them. You understand? So for the fact that the score is already censored at 120, a 2-bit regression becomes applicable. That is a use case for 2-bit regression. I think I was opportune to use that for one of my work on what's it called, dividend policy determinants. You understand? So that is that's one. I mean, that's the third model we're looking at. The fourth model we're looking at is ordered logistic regression. Ordered logistic regression. Ordered logistic regression. Ordered logistic regression is applicable in situation whereby your dependent variable is ordinal, is categorized, is ranked. Your dependent variable is ranked in order, not just the rank. I mean, like when we say somebody, okay, in aircraft you have a business class. You have the first class, business class, and economy. Or you have what do they have again in national premium economy? Yeah. For each class you pay, your ticket money is different, right? Are we together?
Yes, sir. Yes, sir.
Yes, sir.
Your dependent variable falls into that category. And like the example in the manual that we have is also the issue of I'm just trying to issue of what's it called, a credit rating. If you are familiar with a bank, the rating agency like Standard & Poor, Fitch rating, and which other one is that? They rate they rate banks precisely using what's it called? This categorical rating. Some of them, the highest, you can have a triple A or A plus, or B minus, B plus, B this, and the rest of them. The rates. And if your study is based, if your dependent variable, like I said, dependent variable, if there's not, if you don't take anything tonight, please just note that the primary determinant of the choice of regression to run is your dependent variable. Is your dependent variable. That is number one. So if your dependent variable is ordered, is ranked, you know that you have to use ordered logistic regression. Ordered logistic regression. If you use OLS, your regression will still run, but you are using a wrong tool. OLS is not built for that. OLS is built for continuous variable. If you use, if your dependent variable is binary, if you use OLS, it will still run and give you result, but that is not the best result. But for the people that know so much about a statistical analysis, they can never publish your work. In fact, it will be returned based on that, because it's a strong weakness on the paper. You have used the wrong statistical tool. So you must know the nature of your dependent variable. It will guide you on the choice to make. So I move into the fifth one, which is binary logistic regression. Binary, like the word implies, just it's a two outcome. If you're good enough, Sadia's work, we have used it, and I think it's most appropriate here. If your The likely, do they disclose fraud? Yes. They are not disclosing fraud. 0. So automatically, Sadia is using binary logistic regression. Am I lying, Sadia?
No, sir. No, sir.
Your network.
I said no, sir. No, sir. No, sir.
Okay. Okay. So another method you can also use is the still for binary dependent outcome, and that's a binary dependent variable. Is probit regression. When the dependent variable is binary, but the assumption of normally distributed error is preferable over logistic regression. When you are assuming that they are normally distributed, go for probit. Though it's binary, but because of the underlying assumption that is normally distributed, go for probit regression. If you are not sure, both of them, like Sadia's work, if you are not sure, you can, whether to use, what's it called, logistic regression or probit regression. If you are taking logistic regression as your primary model, you can use probit for robustness check. Am I making sense? So taking binary logistic for as your primary model and using probit for your robustness check will also give you a two perspective, whether the data is normally distributed or the data is not normally distributed. Either way, what answer do you have? Does it hold under the two conditions? So you can use one as the primary and use the other one for the alternate for the robustness check. So we'll move to the 7th one tonight, which is quantile regression. This is for me, this is another very beautiful regression that we are not making so much use of in finance and accounting research. It's best suited for, I call it, for robustness check, bringing in alternative perspective into your main model. What quantile regression does is it wants to know if, let me use the example of a firm value. You are doing determinant of firm value, and you know that there are firms, there are companies that are highly capitalized. There are the ones that are medium capitalized, and they are the ones that are small capitalization. So in the Nigerian Stock Exchange, for instance, we have the like of the MTN, the surplus, maybe and you come to the banking sector, you have the First Bank, the Zenith Bank, what they call it, the First Bank, Zenith Bank, UBA, and Co. They are highly capitalized bank. You cannot be comparing First Bank, Zenith Bank with what's it called, Stanley Bank. Am I right? Stanley Bank,
Yes.
where First Bank, Zenith Bank, Access Bank are talking. Stanley Bank cannot be talking in terms of size. Stanley Bank is nowhere, or Unity Bank is nowhere. Because yeah, they are in the same banking sector. So you are you want to run determinants of a bank profitability. You have done your what's it called, or panel data regression. Maybe you have used fixed effect to take into account the firm uniqueness, heteroscedasticity of nature of the firm. But you also want to know. Let's look at small capitalized, small profit-making firm. Since you are looking at determinants of a bank profitability, those banks that are making small profits, what are their determinants? Those banks that are making medium profit, what are their determinants? Those banks that are making high profit, what are their determinants? So quantile regression will now run your dependent variable across different strata. Like it's still the same dependent variable, but it's now looking at it. Let's look at the 25th percentile, 25th quantile or percentile, the 50th percentile or 75th percentile. At the 25th percentile, it represents the smaller, profit-making firm. You understand? Will the attribute, will the determinant of bank profitability for small banks differ from that of the medium-sized bank? And will it differ from those of a high profit-making bank? And you will agree with me that when banks are being classified, they say, I think I tried. Is it Fugas in the for the people in the? You have the First Bank, Union Bank, which one is the Zenith Bank? Access. I think 5 of them. They are classified. Those are the big 5. They're in the upper class. They tend to have the same level of profitability. UBA. They tend to have the same level of profitability. When they are declaring dividends, their dividends are not too different from each other. In fact, I can always, if you follow stock market very well, if Zenith Bank declares 2 naira, GT Bank is most likely to declare 2 naira. You understand? If because they rank pari passu. The year that Zenith Bank, will top up their dividends, maybe from 2 naira to 2 naira, you see GT Bank doing the same thing. So they belong to the same class. So, and you are doing determinants of bank profitability. It's best also you look at it from the spectrum of the quantiles, the different percentile, the medium size, the upper size, and lower class. And that is where quantile regression comes into play. Quantile will just look at it from that strata, that okay, and that's why I say you can use quantile regression as for your part of your robustness check. It says when the impact of an independent variable, on different points of dependent variables distribution is of interest. So you want to know at the lower part, people that are their profitability is low, what will be the determinant? The people that the banks that are profitability is at medium size, what determines their profitability? At the upper class, maybe at the 75th percentile, what determines their profitability? And when you run that regression, you might discover that attribute the determinant at different classes varies. So it gives further insight to the determinant. So for me, I will always prefer to have quantile regression as a robustness check, but nothing stops you from having it as your main model if you are interested in knowing what happened across different strata of your dependent variable. Yes, this number 8 is not too popular. I don't know whether you have heard of this. This visible generalized least square. I'm sure most of us, some of us, no, I can't say most, some of us may not have heard of visible generalized least square method. Visible generalized least square method is most appropriate when you are dealing with the heteroscedasticity and autocorrelation in panel data. So for me, I can also say if I do a panel data, maybe fixed effect, I might want to run a visible generalized least square, probably to take care of issue of heteroscedasticity and autocorrelation. So you might be thinking of using FGLS as a robustness check for your study. Most especially, like we always say that much is demanded of a PhD student comparative to doctoral student. While it's permissible for doctoral student to run one regression, this day, we are not. PhD students is not expected to just run one blanket regression and draw conclusion and say is done with his or thesis. And talking, 2 weeks ago at the I think internal defense, one lady, what's it called? Internal defense was practically dropped because our work was practically classified as too elementary for a PhD work. So let's always consider alternate that's a robustness check for our regression model. The ninth model we are looking at tonight is structural equation model. Structural equation model is popular, but it's not often used. It is most suited for running mediation analysis. It is mediation analysis. It said when examining complex relationship involving multiple dependent and independent variable, because when you are doing a mediation analysis, you are technically you are having at least 2 dependent variable. That's what we are. You are at least having 2 dependent variable in addition to the independent variable when you are doing mediation. So if your model is becoming complex, having multiple dependent variable and independent variable, your choice of analysis is structural equation model. More precisely, you might be looking at a path analysis when you don't have what do they call it? I've forgotten the name of this other type of variable now. Keep my mind. But structural equation modeling is your best choice to address issue of mediation. We can actually run moderation from normal multiple regression. That's it. You can run moderation using the normal panel regression. That one is allowed, but you cannot run mediation using the normal panel regression. So if you are thinking of mediation, your most appropriate choice of analysis is structural equation modeling. It is used for complex situation. It is used for testing mediation and moderation effect. So I think that is that for number 9. The 10th model we are looking at is generalized method of moment. Generalized.
I have a question. Sorry. Okay, is on this this is it more suitable for primary or secondary data? Or you can use secondary data also?
You can use SIM for both primary and secondary data. I was just trying to, there's a word I was trying to pick. A name of variable I'm trying to name of type of variable I'm trying to pick. when you are using, I think for people that are using what they call partial least square, partial least square structural equation model, most of them, most people in using primary data use partial least square structural equation model to run their data, because what do they call it? Yes, is it observed variable? I think the word is not just jelly in my head. What we normally have, I'll get that word. It's most applicable under structural equation model. It's most applicable, but people that use primary data often use structural equation modeling for their work, because the variables in question, they are not directly observable. They use them they derive it from other indicators. When you derive that from other indicator, that word is just says, that term is just striking off my head now. That's when you use, you see those multiple spider, network like a diagram. So people that use primary data, people that are in more of a social research or pure management research, use structural equation model at that level. But for most of accounting research, since we have directly observable independent variable, when we even use a structural equation model, we use it at at the the variable level. The is that word that just is keeping my head now that I'm missing, because those that use primary data, they don't have that. Their measurements, they are not directly observable. So they ended up using this alternate. The only choice they have is to use structural equation model at that level. I think I will get that word. Once I get it, I will come back to it. But to answer your question, SIM is used for both, ideal for both primary and secondary data. So, but if I will ask again, if you use primary data, if you use survey, are we seeing my screen?
Yes, sir.
Okay. If you use survey, you have issued a questionnaire. What would be the most appropriate analytical tool for you to use? Are we together? I asked a question. Hello?
Sir, we are here.
Yes, if you use a survey questionnaire for your study, which is the most appropriate statistical tool to use? Hello?
Maybe this was so well understood, Doctor. Good evening.
Dr. Abba.
Good evening, Doctor.
Yeah, good evening.
I'm going to say maybe it was not well understood. Last part.
Okay, what I'm saying is if you've collected primary data, so which statistical tool will you recommend for analyzing your primary data? Maybe you have used a Likert scale. Hello? Hello?
Hello, sir.
Yes, if you have used Likert scale.
Okay, if you use Likert scale, that means it will be ordered, right?
Are you saying it or you're asking?
I'm trying. I'm giving it a try. So
it's fine.
your data will come out.
I mean, it's
right?
ordered. Yes, it's ordered.
So
it's
ordered logistics.
No, ordered logistic regression is fine. Ordered logistic regression is fine.
After you've done your correlation, you've done your descriptive to understand the data.
And ordered or probability regression is fine. You understand? Because they are ranked.
Yes,
they are not continuous. They are not continuous variable. They jump from maybe 1, 2, 3, 4. They are ordered logistic regression will be the most appropriate. Okay. Yes. We spend so much time on I think on that. What is left now is I think I've dealt with all of them except the last one. The generalized linear model. Generalized linear model is most appropriate when your dependent variable does not follow normal distribution. And also appropriate when dealing with count data or binary outcome. It has different versions, up to like 3 or 4 versions of it. Yes, but I don't think I want to go into the detail of that generalized moment. I mean, generalized linear model. Did I talk about GMM? GMM,
No.
okay, I think I jumped that. Yes, GMM is most suited for the issue of endogeneity. Endogeneity and what we also call for dealing with the omitted variable bias and for dealing with the issue of reverse causality. Do I need to explain all of that now?
Please explain. No?
So, but let's know it. Endogeneity occurs when in situation whereby we are saying that let me give you the example. We are saying that capital structure affects firm performance, right? Let's on our mic. I want us to talk now. I want us to interact.
Sorry, sir. Can you take that again? I was lost, kind of.
Okay. I say in a determinant of profit, firm performance, we can say that capital structure or leverage has effect on a firm performance.
Yes, sir.
So, is there a possibility of performance having effect on profitability on leverage?
Yes, sir.
So, if there is a possibility, what we are saying in essence, some of these independent variables that we have classified as independent variable, are they truly independent of the dependent variable? Sometimes the dependent variable too has a reverse causality on the dependent variable.
Yes, sir.
So our normal OLS, panel data regression, all this other regression does not take into consideration that issue is what is referred to as endogeneity.
Endogeneity, yes.
You understand?
Yes, sir.
A affects B, and B also indirectly affects A. So then
Yes.
there's reverse causality.
Yes.
There
Yes,
is
sir.
but our normal regression model does not account for that. So that's why in some space, if you run in some space, I know that there's still a divide in the academic. If you run your OLS or your normal panel data regression and you are using, and you are concluding that what's it called, this one has effect on this, they will tell you no. Your normal panel data cannot run, we cannot run a cause and effect on normal panel data. But that's a controversial aspect. But I know that most of the Western journals, that is their standard. For you to prove causality, you need to go further to running 2-stage least square, 3-stage least square. Using a generalized, a system GMM, difference GMM, to prove beyond doubt that there is actually a causal effect. You understand? So that is, let me stop. The issue of endogeneity ends there, as in reverse causality, and also GMM addresses the issue of omitted variable bias. It tries to more like take into consideration that there's possibility of omitting variable that impact on this relationship, and find a way to make an adjustment for that. So I think with that
sorry, sir, can you go back to this missing variable bias?
The omitted variable bias.
Okay, omitted variable.
Yes,
okay.
Omitted. In the sense that your model can never capture all the variables that impact on the dependent variable. Is it possible?
No, it's not possible. There could be other variables that can impact the DB.
Yeah, because it's not possible. That's why you can run. Your model. You can run a model for determinant of a bank profitability. Use XYZ, and somebody else can use ABC. To run determinant of a bank, the same bank profitability, because there are a lot of variables that determines this outcome. Is the ones that we can see or we are interested in, or guided by theory. That is what we are using. You understand? If not, determinant of firm performance can run into hundreds. You can start bringing in the quality of the caliber of staff, educational qualification of staff, the working environment. You can bring in all sorts of things that can impact on it, but it's not all that we cannot capture everything. So, but what GMM try to do is also to work with the assumption and find a way to factor in the possibility of omitted variables and taking it into account. You understand? And again, most importantly, for us in finance and accounts, in research, there is autocorrelation. I think it addresses the issue of autocorrelation. GMM addresses the issue of autocorrelation in a special, because when you say autocorrelation, term value last year is already a determinant of term value this year. The dividend a company paid last year is already a determinant of what they will pay this year. Somebody can go to sleep and say, since what's it called, First Bank paid 1 naira last year, they are not likely to go below 1 naira. True or false?
True.
True.
So past performance is a determinant, or part of it is a partial determinant of future performance. That's what we are saying. So in GMM, the issue of lag variable comes into to bear. You bring in lag variable of the dependent variable. These are issues that, we're talking at the surface. We cannot, let me say, a bird eye view of all of this model. You can't capture all of them finish in one night. So GMM brings in the issue of lag variable. When you lag variable, it means you are saying that previous performance is part of the determinant of present performance. A bank that made 1 billion naira profit last year is already an indication that perhaps it might not make less than that, or it will not fall below that range. You understand? So past profit, if you are talking about a determinant of a bank profitability now, you should now be taking into account the persistency in profitability. You cannot expect what's it called, First Bank to make 10 billion last year and suddenly drop to 2 billion naira this year. Is that a normal occurrence?
At all.
So past performance is already an indication of your present performance, and it's also for it's almost applicable in every sphere of life. Somebody that has run 10 minutes, is it 10 seconds for 100 meters in the past? You can also say the performance will be in the range of 10 seconds. It cannot suddenly drop to 12 seconds. Something must be wrong. And it cannot from 10, if it drop to 8 seconds, the person will be taken for steroid test. Are you getting me? So your past performance is already an indication of your present performance. So there's what is now called persistency test. You lag your dependent variable. You bring in your dependent variable into the equation you are running. If you look at some of the this journal, you will see what you start looking at for it. When you see lag, if ROA is your dependent variable, and you now see lag ROA, that's L.ROA. That means what you are saying is the past is also part of the determinant of the present, and which makes sense. It makes sense. I've given the example of profitability. I've given the example of what's it called, dividend policy. You understand? Even if a firm that has been has engaged in earnings management in the past is likely to also engage in earnings management in the present. So it could be lagged. So the past can actually be part of the persistency of your performance of the past contribute to your present performance. That's one of the things that GMM brings into consideration. So if you want to test for persistency, you want to account for persistency, you bring in you use GMM. GMM, I think, popularized by Areola and Bond, and what's it called? Areola and Bova and Areola and Bond, something like that. They are the one that popularized that method. I think it's one powerful tool for addressing endogeneity. All this that we have discussed has been summarized in a table, and I think at the end of the day, I'm going to share this. This note contains all that we have done from yesterday till today. So we are going to share this note so that we can look at it further. Yes.
Okay.
Go ahead.
This GMM, you said it accounts for, let's say, if you're looking at determinants of profitability.
Yes.
So, and since it is determinants and you've chosen your variables, so GMM can account for other determinants, right, that can affect profitability. Is that so?
No, what GMM is accounting for is basically the issue of endogeneity,
yes, sir.
and autocorrelation.
Okay.
Which autocorrelation, which often than not, our normal OLS or panel data regression will not account for it. Autocorrelation is that means autocorrelation is simply as in persistency, a 2. Gosh.
Okay. I was asking the question because initially, when I chose my topic, I used the word determinant. And I remember Mr. Henry telling me that if I should leave it at determinant, that means even during my final stage, the interviewer can just say determinants. There are other things that can determine this particular thing. Add this to it, go back and redo the work. So it's open, so I have to close it. So I was thinking you said that GMM could account for other variables that could impact a particular phenomenon that have not been met.
Okay. It has to account for what's it called? Omitted variable bias.
Yes, omitted variable. So does that mean because
bias,
I have another move on ground for me to change my firm attribute back to determinant? So now if I'm to changing back to determinant, I will now run GMM. Will it close it, or I still have it open? Anybody can just throw in anything by telling me that interest rates will impact this because it's open determinant.
Okay, let me respond. That's a good one. When we use determinant, is very wide, and it's like I said earlier, determinant of any variable is unlimited, kind of, because we don't know it all, and that's why a researcher A can use 5 variables here, another person will use another 5 or 10 variables there. They are all still determinants. So, but if you want to use determinants, fine, GMM can help. It will help, but it's not a silver bullet, and I don't think there's any silver bullet anywhere. It will surely help, and it can help put a foreclosure to that matter. That the argument is it also meets as adjusted for omitted variable bias. It has the capacity of adjusting for omitted variable bias, but that is not to say that now you bring in maybe three independent variable, and you are saying you are dealing with a determinant because you are using GMM. No, you are not being let me call it, you are not being objective enough, because there are other independent variables that are within your reach, that you can easily bring in. You understand? So the thing is, bring in as much as possible, but do not flog me. you are doing the determinant, if I'm doing the determinants, I'll be looking at least having like up to like 7 to 10 dependent, independent variable. In addition, if I now use what's it called, GMM, it only puts it helps to account for, adjust for, or penalize. Let me penalize for omitted variable bias. It penalizes for omitted variable bias, such that the conclusion you are making now, those ones that you omitted, adjustment has been made in this calculation to take care of them, kind of. But you know that is also an estimation. But it's better to have it than not to have it. And it's better you are adjusting for the omitted variable bias. So if you are doing determinant and you have a sizable number, you can use a GMM to address that issue of omitted variable bias. And it's a strong point for me against any person that want to raise the issue of their other variable. It's a strong point, but I can't say it's a final answer. It's a strong point. That's what I can say.
Thank you, sir.
Thank you very much. Oh,
So Simon,
I promise. Yes.
sorry, what you just said is germane, because I think last week somebody presented.
Thank you,
So
sir.
they asked the person that how come you didn't use other proxies, that you have all those proxies under your independent variable. Is it that they don't have another proxies in that? So it's now that I'm trying to link what you're saying with what they asked the person. So when the person mentioned, when the person had his own independent variables, but he didn't capture other ones. I think it was the one he felt would
So
suit
those are some of
the work.
Those are some of the questions that can
Yes.
come
So
up.
I was wondering why they said, is it that they don't have other ones that you can use? Why did you choose to use these particular ones, which the person knew that there are other ones that could even still affect that particular thing? So that the person couldn't say anything because it was only these ones that the person had in mind, which there are other ones. So when you're saying this, that reminded me of what they asked the person, which the person couldn't answer. So with this GMM, if you use this GMM, can he still answer that?
I think it's the same thing I'm saying. If you have brought in sufficient numbers, GMM cannot be used as a defense case. But do not bring in so little and open for GMM to account for them. That
I
will
think
not
the
be fair.
person brought up to 8. The
But
person brought up to 8. And I don't know why
8
the
is fine
question
enough.
of yes, 8.
8 is fine enough. And with
But I don't know why they were asking the
GMM,
person.
it will now be used as as a buffer. You understand that? Okay, with GMM, I'm accounting for omitted variable bias.
I think I'm getting you well now. Thank you.
Okay, thank you. So we spent so much time. Can we still go on? Are we together?
Yes, sir.
I said we have spent so much time.
Yes.
Can we still go on?
Yes, sir.
I want to run. I want to run some regression now. Are we okay with that? I'm looking at time. Nobody is talking. I should continue to talk.
It's okay.
Okay. No problem. I'm on starter environment. I'm just trying to record my files. What are we? Okay. reminders. Okay, so like yes, I have this data set that I normally use for my YouTube channel. I think I always use it for that's the consumer goods sector data that I had some years like 2 or 3 years 2 years back now. Covers consumer goods sector from 2012 to 2022. So I want us to look at it. We'll use it to run the regression. Now, the problem is as I open other windows, it's static on this particular window. Okay, I need to drop this and I need to change window. 1 minute. Stop sharing. Yes. Yes, this is the data set that I have. We have year, firm. You can see the Vitafoam, Unilever, PZ, and Co. There are 16 firms here. The firm ID is there. Dividend per share, Tobin's Q. This is institutional ownership. You can see the full name here. You're seeing where I highlighted. Yeah, that's it. That's institutional ownership. And this is turnover. That's the firm, the revenue. This is ROA. This is equity to debt ratio. Equity to debt ratio. So I'll be doing some fast running. Since I think we are recording this section, if you have the opportunity of going through it again, you can go over the video. So, but my problem is alternating between windows is my challenge now. I need to drop this again. But you have seen my data set in starter environment. Let's talk because this I want it to be interactive. Let's ask questions. 16 consumer goods spend a period of I think this 160 observation. That's for a period of what's it called? 10 years. That 10 years. Okay, from 2013 to 2022. That's a 10 years observation per firm. So 16 firm times 10 years. That's a 160 observation. So I'll go to the main starter environment now. Okay, I want to start with a normal OLS. Normal OLS. I have my codes already. So to fast track it, I'll just be doing some copy and pasting, but I can explain them. What I'm doing here is the normal ordinary least square regression. The command reg. I was saying what I highlighted. Reg, that's the command for OLS regression.
Yes, sir.
My dependent variable comes first. DPS is my dependent variable. Independent variable is Tobin's Q, institutional ownership, turnover, ROA, equity to debt ratio. So I have 5 independent, right? 5 independent variable I'm regressing. So this is the command. If I haven't gotten it right, enter. That's I'm done running the OLS regression. And from there, you can see let me do a quick interpretation. What it means is Tobin's Q. See my highlight is highly significant in the relationship. Equity to debt ratio is significant at 5% level. So, but like there are more things you need to iterate. Sometimes, for you to be satisfied with what you have. This is just basic OLS. I might want to test for what's it called, multicollinearity, which I use a VIF to test. There's no issue of multicollinearity here because our VIF values, they are all below 10 pieces. The 10, the value of 10, the threshold. Anything above 10 will call for worry. So we don't have issue of multicollinearity in this model. Again, remember our R square is 48%. It tells us that this model explains 48% of the factors of the variable that impact on a dividend policy. Simple as that. You understand? This is normal OLS. So suppose I want to go for panel data regression. I move again. I bring in another code. We'll go run a panel data regression. Like I said, I'm copying and pasting my code. This is to run a panel data regression. Are you seeing my code? No, I'm not sure. Okay, yeah, it's there now. You can see the code. That's 3 panel data regression, fixed and random effect. Fixed effect. I need to get your response. So it's like I'm alone here.
Dr. Simon, I don't even understand it too.
Dr. Blessing.
I'm getting confused though. The way the diagram is just moving up and down. Voila.
Is this your first time running OLS? Running regression?
For me, at this point, I feel like as if you are speaking another language. It's not my first time. I've never run it myself, but the only thing I do is to watch people run it.
The same thing to me. I just watch people doing it, but I don't know how they do it.
Other time.
The thing is, for today, we are still going to watch you do it, but I think we may need a physical physical class that somebody will do it. Me looking at somebody doing it doesn't solve problem, honestly.
Okay.
I agree with you, Sadia. It's a physical thing.
Sadia.
It's only a physical thing that we can understand.
Yes, sir.
No problem. We can always arrange for that. Let's have
yes, but the only thing I can assure you to encourage you is that it can never be the same with somebody that's never even watched somebody do it. At least watching somebody do it is different from when you have never watched it. Abi?
Absolutely.
It's to do it that is the problem now.
Absolutely. Yes. For you to run, okay, let me just say, let's have a bird's eye view of what we are doing. I'm going to do the regression, and the first one I did, the first, that's the OLS regression. I will just do it, let me call it, not copy and paste now.
Sir, sir, I don't know if it is, sir, I don't know if it is too much to ask, but yes. Can we get the command? As in, how can we get the command? I want to have it in the notepad so that if I install my application, I'll just copy it.
It's a template.
Yes,
a template.
No. Apart from the template.
Okay.
This command,
the manual and the command. Maybe I will copy and paste the command into the manual.
Yes.
Okay. Okay.
I will copy and paste the command into the manual I'm going to into the manual I'm going to share, so that you can actually pick them and run. But again, you need to generate your variable.
Yeah, no problem. There's no problem for that. It's just the command.
Okay,
The
fine.
command to run this particular, let's say, to put regression, Houseman test, Lagrangian test, normality, all this command, we need it in a notepad that you can just copy and paste.
No problem. No problem.
Thank you, sir.
Okay. So, I'm doing the OLS regression, just like I will do it. I used to do it some years back. Okay, reg. I will go and look for the variable in question. My dependent variable is DPS. That's representing dividend policy. You saw my cursor there. If I double click on it, it will come to the command line. Are you seeing it now? Right?
I think it's off. I don't know that I'm not seeing it. It's on now.
I can see it.
I can see it now.
Okay, maybe it's okay. So I picked the dependent variable. The next is for me to pick the independent variable. I've taken Tobin's Q as one of the independent variable. I will double click on it. It comes down. So Tobin Q is down. Institutional ownership is down. By double clicking on it, I will double click on turnover, and also double click on ROA and equity to debt ratio. So what we have done now, this is the command for OLS. We are saying that regress dividend per share against the independent variable, Tobin's Q, institutional ownership, turnover, ROA, and equity to debt ratio. And you hit on enter, similar to what we have done before. So the result, maybe this is, I jump into regression. Maybe normally what you see in your papers, you want a descriptive statistics, you want correlation. Am I right? Am I right?
Yes. You're right.
Let's start with descriptive statistics. If I want to do descriptive statistics,
you are always right, sir.
No, I can't be always right.
No, in this situation, you are always right because we can't tell if you are right or wrong.
No, you can tell. You can tell. I said in your paper, when you are writing a seminar paper, descriptive statistics comes first, correlation follows before the analysis, before the regression.
Yes, sir.
So
yes.
I want to run summary statistics first. That's the descriptive statistics. That's where I use the word sum. This is the command I use, sum. Every other thing remains the same. I only change that regress to sum. So if I hit this one now, you have your summary statistics. So this is the summary statistics that you normally see in your papers. Are we together? So that is descriptive statistics. We can also do the correlation. If I want to do the correlation, I'll only change this sum to correlate. TORR. I think so. That's the only thing I've changed.
I want to have topic that I can literature review.
So, are you seeing my command line?
Yes, sir.
Correlate.
Yes, sir.
Yes, sir.
If I put enter now, you have your correlation matrix. This is the correlation matrix that normally will be in your paper.
Okay.
So normally you start with the descriptive statistics. You see the number of observation, the mean, the standard deviation, minimum value, maximum value. Yes, on Saturday, somebody minimum value was greater than the maximum value. I don't know who saw. Blessing, did you see that?
How?
I saw it. But what was the cost?
In last Saturday's presentation,
I saw
somebody's
it.
minimum value was greater than the maximum value.
How?
Why was it like that? What cost it?
The person was entering those things manually. That's the only way that can occur. It can never be from the statistics. It can't be from the software. Maybe the person was
negative.
Whether it's JJC.
Whether it was negative and he forgot to.
No. He copied me. All these figures, you don't copy them manually. You get them, from the status software and straight to your work. Straight to your work. Even though if you copy like, if I copy like this to Word, it might scatter. But there's a way you can actually do it that it won't scatter. You understand? So I've done the descriptive statistics, correlation matrix. I'm not doing any interpretation. That's fine. Is that fine?
You interpret.
I have a question, Chief.
Okay. I'm managing your time.
It's the interpretation that is the main thing now.
Sorry,
Okay.
a question.
Go ahead, please.
Yeah, if you look at the Tobin Q's minimum value is a negative. And Tobin Q is used for measuring, is one of the variables for determining the value of the firm. So is it possible for a firm to be having negative value?
In the descriptive statistics, I can't see any negative value for Tobin's Q. I just highlighted Tobin's Q now. I don't know whether we are looking at the same thing.
Okay. That point, I thought it's a negative sign. It's not showing so well on the screen.
It's a 0.40.
Okay, I'm sorry about that, Chief. Yeah.
Okay, so it's not minus, it's 0.40.
And the maximum is 9.4.
Yes, 9.4. Yeah.
So the interpretation, what does that one mean?
Interpretation is that the highest valued firm has a Tobin's Q value of a 9.4. Which is
industrial standard.
Because Tobin's Q is measured in relation. Tobin's Q is measured in relation to the value of the firm in relation to the book value. Value of the firm, which is measured as, this is the market capitalization, the external price and the book value. So what it means is a firm that is having 9.4 as value, that means that firm is highly valued it has high market capitalization, market value compared to the book value.
Okay.
So for the firm that is having 0.40, its market value is lower than the book value.
Okay, that's the current value.
Yeah, the market value is lower than the book value. For the one that is having 0.40 something, the one that is having 9.4, the market value is, more like 9 times higher than the book value, so to speak.
Okay.
You understand? So for dividend per shares, it means, for you to have a zero value, it means some companies don't pay dividends. And the highest value means in this sector, there are companies that pay as high as 68 naira per share dividends. For institutional ownership, minimum value is 9, maximum is 95. That means the minimum shareholding of an institutional shareholder in this sector is 9%, whereas it goes as high as 95% in this sector. You understand? So turnover is has been logged because it's logged. So the turnover value ranges between 5.4 and 9.4. So there is wide disparity in turnover among the firms in the consumer goods sector, whereas the mean value in that sector is 7.5. The mean value is 7.5. The low value, the minimum value is 5.4. So coming to profitability, ROE, return on assets. There are companies that are making losses. That's why you have a minus 18. And there are companies that are returning as high as 26% on the assets. So while some companies are actually returning 26%, making 26% return on assets, some are making as low as minus 18% on the assets. So for equity to debt ratio, yes, this cause for concern. This value cause for concern. There must have been some data for this equity to debt.
I'm not seeing it. I don't know that I'm the only one not seeing it.
Are others not seeing it?
Please confirm. I'm just seeing it now.
We can
I've
see
seen it. It left. It went
It
and
will
came
go,
back
it will
again.
come up. It will go and come up. So it's not stable.
Okay. Maybe
Oh,
because
but
I'm automating.
it's stable actually, except if you have a
Yours?
problem with the network.
Maybe it's network.
Yeah, yes, sir.
Okay.
Sir, I actually noted. I also noted that return on assets and then equity to debt ratio being as much in negative as we can see there. But then to add to my questions, if we
Yes.
have about 20, we have 25 companies in the consumer goods sector listed on the Nigerian exchange, and here we are having 16 used. Is it that there was some kind of a purposive sampling, or how did you reduce it to 16 instead of 25?
Well, I'm not, sincerely speaking, I'm not, the maximum I've seen in the consumer goods sector in my work has been 21 firms. I'm not aware of 25,
Oh, sorry,
25 firms.
is 21. Sorry, it's 21. 21.
Okay.
Yeah, not 25.
Okay. Okay. So normally some of them might not have up to the 10 years data span. I know of some company that got listed that in the period, maybe like the Boa Food or so, and some other company like that, they don't have up to 10 years. You understand? So if you eliminate those ones, and maybe they will be up to 6, I can't really say, but these are the ones that actually satisfy the having data, complete data for the 10 years. You understand?
Okay.
You understand? So you might take it as a purposive sampling, that these are the ones that at least their financials are available and they were listed in the past. In the period of study with full years data. You understand? So those ones with 2 years, 3 years were eliminated.
Okay, sir.
Okay. Thank you. So can we move forward? Okay. I think I've done a little. Yes, I was talking about for ROA. there's no problem having negative with ROA. Companies are allowed to make, they do make losses. But equity to debt ratio can never be in negative, if I'm correct. Or no, if I'm, let's look at it logically too. How would that happen? No, I think it's a possibility. It's only a possibility if what's it called, shareholders fund are actually in negative. Am I right? But that negative value calls for probing. I need to probe it further. I need to probe that negative value further. Those are some of the things. That's the kind of a thing that Professor Farouk will see and flash your work that it is not possible. But you need to explain it further. You understand? You need to explain it further. So why would? Because equity. Let's what's the formula for equity to debt ratio? Total equity. Total equity divided by total debt.
Total debt.
So what will bring about negative there is only when your equity is in negative. Maybe the shareholders fund is in negative. That is the only thing. So, but you need to prove it to show that that company actually is in the loss zone. So I wouldn't know if I scan through here to see where the loss.
So that is why someone like the VC would say he needs to see the raw data.
No, but again, look at it. When you talk of raw, these are raw data. Sometimes you need to justify. It's not a matter of, like, I've just gone to the back end. Champions Breweries is most likely to have such problem. The company that is recording this negative, what's it called, equity to debt ratio is Champion Brewery. By the time you go and look at their financials, they might be in loss. Their raw financial, they will actually be in loss zone. There are some companies, if you go to maybe in the tech sector, a company like Omatech has negative shareholders fund. There's also another company in very funny companies. Like I've noted like 3 or 4 of them because I've done something on negative share capital before. Like 3 or 4 of them, they have negative share capital. So you will see some high leverage in thousand. So, but if you bring in their, let me call them outliers. Okay. That said, correlation is just is a measurement of association. So normally you interpret it in the paper. You have the association between Tobin's Q and a dividend per share is at 0.66%, which is positive. They are positively correlated. Which is fairly good enough, because correlation ranges between +1 and -1. For somebody that is the maximum you can get for correlation is 1. That's +1 or -1. So if it's moving, Tobinski is moving towards 1, approximately like is at around 7. So Tobinski is positively correlated with a dividend per share. Institutional ownership has a positive but weak correlation. Positive but weak correlation with a dividend per share. Turnover has a positive and it's still a weak correlation with a dividend per share. ROA has a fairly positive correlation with ROA has a fairly positive correlation with a dividend per share. Equity to debt ratio has a weak positive correlation with dividend per share. They are all positively correlated. That's just the simplest interpretation I can give to Tobin's Q. To correlation matrix. You can interpret every other one, but I've taken my time to interpret only the relationship with the dependent variable, because that's our variable of interest. The dependent, that's the outcome variable. And in some journals, you can just do your interpretation based on your on the relationship with the dependent variable, and you are fine. So, but for want of time now, I think we need to move forward. What can we do next? Are we together?
Yes, sir.
Okay. I think we'll need to schedule another session. So much to be done.
Yeah.
So much to be done.
I
agree with
yes,
you
I agree.
100%. Nature overloads.
Huh?
In fact, let me advise. Let me advise.
Go ahead.
The day we are going for this, we should do strictly practical. We shouldn't talk about all those, those things from the beginning, because, this consumes a lot of time, and this needs fresh brain. If you notice, when in secondary school and primary school, mathematics is taken in the morning, early in the morning. So please, even if we have other questions, we should keep them aside and attack these ones. Then when we know how to do this, yes, we can talk about other theories.
Okay, I think I align with Sadia. Okay. I think we need to wrap up. Let's wrap up with a panel regression. And we'll possibly pick another date for us to do more of this analysis. So, as you can see on the screen, panel data regression is next. The command is a little different from OLS with the two letters, that's ST. As you can see, adding ST to it suggests to me that it means that we are doing panel regression. Okay? And at the end of it, when you have a ST, it stands for fixed effect. The random effect is the one that is having RE. So once you estimate the fixed effect, you have to store it in the memory of theta. That's why the word estimator fixed. So it will run the random effect. Similar command, the last word there is what distinguishes it. That's the RE. It will also estimate and store it as a RE. That's random effect. So once you do the two, the next thing is you can then conduct your Osman test to determine which one to go for. So these are the commands to run the fixed effect, random effect, and the Osman test. With this, if I click on enter, it will run the all of them. I can scroll down. So we started from yes, this is the fixed effect panel data. Number of observation remains 160. Number of group representing that's saying the number of M's in the group is they are 16. So you have the what's it called? The R square. You can observe that the R square under the panel data under the fixed effect is quite low. Within effect is 2%. Between is 11, and overall is 8%. So under panel data, it has little explanatory power. compared to OLS was around 40, what's the R square in OLS? R square in OLS was around 48%. So fixed effect only demonstrated 2% within effect, which is very low, very low, very low. The random effect is even much lower than a fixed effect in R square. But the model, the same number of observation, the WAT test for model fitness is fine. The model fitness is fine. Yes, I'm just rushing, but I know that we need to round up now. We need to round up. We spend so much time. The Osman test to decide between a fixed and random effect is also there. I think since it's significant, we are going for the fixed effect. So each fixed effect to better capture this. But I think it's better for us to stop at this point, and fix another date for the practical session. So those in favor say aye.
Aye.
Stop.
Aye.
I was thinking since the significance level is the one that will go for the fixed effect. Isn't it going to be okay to at least have a little look at the interpretation? I don't know, but then it depends on the general consensus.
No, I didn't get you.
So I was going to suggest that since the p-value is significant and we are going for the fixed effect, can we have a look at the interpretation, or we should suspend it to the next class?
I'm just giving a one-off interpretation. The Osman test result here suggests that a fixed effect model is preferred over the random effect, just because the p-value is significant. If it's not significant, you go for the random effect.
Yeah. All right.
Okay, Doc, you know your R square. I noticed that your R square is very low, and what they said, it has to be between 25% to 75%, and not too much on that's I said between 25 to 75%, but yours is below 25%. So how do you treat this one since it's very low?
Yes, I noted that the R square is very, very low. 2% I noted it, but I also said that it's better under the OLS. Under the OLS, it was around 48%. 48% for OLS. So that means in the panel regression, it's not good enough, and that's why we'll talk of the methods. If I take this particular model and now I know what to. If I take it now, if I really want to work with this data, perhaps I might consider using what's it called, a Tobit regression for it.
Okay.
So
I'm getting you now.
You understand? My then account for is zero. That is zero dividend paying, because we have firms. How do I do? Okay, let me do. If that will come up. I just want to DPS. If the histogram will come up. So didn't get that command. It's to why? Oh no, it's not the. I'm not getting my spelling right. It's DP. It's DPS, not DPR. Yes, DPS. Yeah. I want to show you a graph. That graph. That's from that command. You see this graph. Are you seeing the graph on your screen now?
Yes, we can
Yes,
see.
sir.
Yes, sir.
So it's showing a lot of the firms are actually at zero, not paying dividends. So, and if you recount my discussion on Tobin's Q, I said Tobin, on Tobit's regression. Tobit regression will be better for this model because the data is skewed to zero. A lot are not paying dividends. The few that are paying dividends, you can see their dividend, they are just they are not, the frequency is not much. Their frequency is not much. Because of this zero paying dividend firm, and I'm doing dividend policy. So since it's skewed, it's censored. If I use a Tobit regression, I'm better off than using panel regression. So this is where, somebody that knows is econometric, if I presented this as a paper, will tell you, no, the approach that I use is wrong. You understand? Perhaps I should consider using, what's it called? Tobit regression. You understand? I think if that will help, I want to look at this using a Tobit regression. I think that should have been the next. The command for Tobit is what I've pasted. Tobit, like if you see it on the screen, the last command there is that I'm censoring this regression to zero. It should not be less than zero to account for those, take care of those firms that are also paying, that are not paying dividends. Now, oh, sorry, it's only graph you are seeing. I didn't know I've changed. Okay, I thought I was showing me. I ran a Tobit regression while that graph was on. With a Tobit regression, the model actually improved to, the R square model actually improved to 10%. But in Tobit, it's pseudo R square. You don't equate it to the normal R square. So a 10% for Tobit can go easily, but you cannot pass a 10% under a normal OLS or panel regression, because that's why they use the word pseudo R square. It does not measure the same thing as your normal, measure the same normal way your normal R square would measure. So this is perhaps another way of just once you know the nature of your dependent variable, it will always guide the choice of your analytical method. You understand? So, but I think in our next section we'll have more time to explain and go deeper into all of this stuff. So at this point, I think I will want to, but okay, I know what to do. I will share the lecture notes via the email addresses that we have. So
thank you so much, sir.
I'll move the motion. I
Thank
think it has
you.
been seconded by everybody.
Thank you so much.
God
Thank
bless
you.
You, sir.
You have tried.
Thank you very much.
Thank you
You've done
so
well for
much,
us.
sir. We're
Thank you,
grateful.
Dr.
Thank
Precious.
you, sir. Thank
You're
you.
welcome.
Thank you.
God
Much
bless you.
Thank
grateful.
you. Thank you.
Thank
Dr.
you.
Simon, thank you very much.
Thank you.
You're
Simon,
welcome.
thank you. Dr. Precious,
Thank
thank
you.
you. You're welcome.
Dr. Precious, thank you.
Dr. Precious, thank you.
Welcome.
Dr.
Nadia.
Precious, thank you.
You're welcome.
Francis, go
Thank
and
you.
sleep. Go and
Hello,
sleep,
Dr.
Francis.
Precious. Dr. Precious, please, we are really grateful for
Sadia,
you.
if by now you
For
should
this
be fast
fantastic
asleep,
session.
won't you go to
Please,
work
can we get
tomorrow?
your contact?
Thank you.
Dr. Precious,
Yes.
please, can I get, is there any way you can get, can we get your contacts? If we want to reach out to you, how do we get in touch? Please.
Contact Blessing.
Okay.
I will get our contacts,
I
both
will send
contacts.
my
I will drop
contacts
it
to
on.
you.
I will drop
Okay.
it on our platform, eh?
All right.
I will
Thank you
drop
very
the
much.
both numbers on all the platforms, eh?
Okay.
Okay,
Thank
So
you
that
fine.
you can reach out to her anytime.
God bless you.
Thank
You're
you.
welcome.
Good night,
Thank
everybody.
you. Thank
Good
you,
night.
Mr. Person.
Oh, thank you
Good
very
night.
much.
Good night,
All
sir.
right.
Thank you.
Nena.
Is it Nena here?
I didn't know she was even
I'm
there.
here,
Nena.
present. I'm
So you
here.
are there. It is well, oh. Good night, oh.